Guys, this is CT Johnson, and today is day 141 of the COVID 19 pandemic. This is the Funding Doctors Financial Survival Guide. Today, I want to talk about as a guide for private lending for first time borrowers. I have a lot of people now who are starting to approach me because they previously dealt with the banks. And now, because the banks have tightened up their lending criteria, they now are starting to look towards the private market. And they frequently run into a lot of the differences between private and bank lending. And they are sometimes dismayed, sometimes they're really pleased with it, but they're always surprised in one way or the other. So I thought I would give a guide for if it's your first time that you're getting into a private lending type deal. Let's talk about what you can expect. One of the first things is that serviceability is less of a concern. So private lenders, for the most part, don't look towards serviceability as much, particularly if you're talking about things like construction loans or short-term loans or things like that. What they're looking toward is the exit. So how is it that you're going to get out of this, and how are you going to pay back the loan? Number two, collateral is more of a concern. For exactly the same reason that serviceability is less of a concern, collateral is much more of a concern. So they will tend to look more strongly at the value of the assets, and frequently they'll look more conservatively at the value of the assets. One of the things that you'll notice is that loan to value ratios tend to be lower for private deals as compared to bank deals. This is one of the ways that they manage their risk, and one of the ways that they put more of an emphasis on collateral as opposed to on the serviceability. Number three, pre-sales are useful but not critical. It's pretty common that in a bank deal, particularly on, for instance, construction, well, that's the only place where you'd have pre-sales, but in a construction deal from a bank, they would require 100% pre-sales. Sometimes they require more than 100%, meaning that you have to sell enough units, pre-sell enough units to cover more than 100% of your debt. It's very common in the private world that you won't have to do that. So for many deals, they'll give no pre-sales type deals. And for some that require pre-sales, they'll do much less than what the bank would require. So that's a way in which they're quite different. Number four, privates will take more risk. It's just a thing that happens pretty often that a deal that just couldn't get through on a bank basis, that the privates will look at it and say, no problem. They'll adjust the rate for it, but they will at least do it. So if you have a deal that is too risky for the bank to do, then privates are a good option because they will tend to go for higher risk levels. Number five, privates are more serious about defaults. This is one of the reasons why sometimes they get negative press and people have a bad feeling about them, is if the deal starts to go down, they tend to move very quickly, and frequently they will move straight to debtor in possession. It's very common also that they will try to work with a developer or the person who has the loan to try to find an exit from it, because most of them don't want to own the asset. What they want is they want their money to be protected. They want their principal to be protected and their interest that they've earned to be protected. So they'll frequently work with people on how they're going to get out of that default. But if they don't have a way out of that default, they will move straight to debtor in possession, and they will sell off the property for whatever they can get for it. So that is a significant difference. Banks tend to move a little bit slower, and the privates tend to move faster. Number six, privates are much more flexible. So banks will tend to give you a standard deal in terms of terms and conditions, and there's little that you can do to change that. With privates, it's all negotiable. So if you have a really, really great deal that they love, they'll probably give you, they'll be very flexible on the things that they give. On the other hand, if you have a deal that's risky and it's hard to finance and they're the only ones that are going to do it, they won't be as flexible. But generally speaking, they'll be much more flexible than the banks. Number seven, privates are way faster. They move way faster. One of the things that is people are frequently surprised about is that after they've been dealing with the banks for a certain amount of time, they'll come to me and they'll say they're frustrated because they've been dealing with something for, I had a guy earlier in the year who had been dealing with one of the big four banks, and he had been going for more than 12 months in trying to get a deal through. And he just was so frustrated, and he came to me and he asked how long it would take to get a response on whether the deal could be done. And I said, well, we'll have an indicative offer probably within 24 hours. And he said, no, I'm sorry, you're not understanding. I'm asking like how long before, not how long before you submit it to the bank, but how long before the bank gets back to you or the lender gets back to you. And I said, no, I'll submit it to them probably today, and they'll probably get back to me tomorrow and say whether they want to do it, and if they want to do it, what type of pricing they'll do. And he was bowled over by that just because things move so much slower in the banking world. Number 8, privates are more expensive. This is probably the main area where people who have been doing bank loans previously and moving into the private sector, where they are most surprised and what kills most of the deals, and which is fine. It just means that you need to understand sort of what you're getting into. So the banks are mostly getting their money from the RBA and from depositors, both of which have a very, very low cost of capital. So you can think about what you're getting on your savings account, which is maybe 0.25% or 0.5% a year at most. That's what the cost of capital is for the bank. On the other hand, think about your super, and when you invest things into that, frequently what they're talking about in terms of returns are 6% or 8% return a year. So that's the cost of capital that the privates have, because that's where they're getting their money, is from private investors who are putting stuff into it and expecting return out of it. So the cost is higher. So in general, this is sort of the picture that you see, is that the banks are less flexible, they're slower, but they give higher LVRs and they have lower pricing. On the other hand, privates give lower valuations and much higher pricing, but they're way faster and they are way more flexible than the banks in terms of getting stuff done. So it really is a matter of horses for courses. If you have any questions about this, if you are a first-time borrower and you are getting into this and would like to understand a little bit more about how privates work or what you can expect, please give me a call. My name is C.T. Johnson, and I'm the Funding Doctor. Take care.